Let's get to Evan Lucas. He's joining us from IG in Melbourne. Good morning to you, Evan. I'd just like to start with perhaps that copper price, because is it too long of a bow to draw saying that's a reflection of the China data and perhaps, even in anticipation of this trade balance we get today and GDP next week?
No, it's not, Nadine. I think you've also got to throw in there one other aspect, and that's the non-farm payrolls, and therefore the speculation that comes with how fast tapering is going to happen. And all of that at the moment is certainly being a really big major push down on where you're seeing the copper price. Having a look last night over on the CME, it dropped 1.3% to roughly around about $3.29 a pound, and over on the LME, it dropped around about 1.8% down to $7,213 US a ton. So it wasn't exactly a good night for copper, and as I said, it's almost got a double pincer effect in the fact that the demand for copper over the next 3 to 4 months, depending if you look at CME or LME, so out to March and also out to as far as April with some of them as well, is expected to fall away because we're seeing, a really big major move down in that PPI read from China. 22 consecutive months, as we already just mentioned, but that means it's going to be the longest decline in purchasing internet since around about the early 1990s, and all of that is putting into that fear: is China slowing down? How fast is it slowing down? And the demand for industrial metals is obviously the one that gets put in the biggest sort of holding pattern, and copper is the big lead indicator there, and that's why at the moment copper is the one to watch. It's unfortunately, particularly from a stock perspective, also going to be a negative here. We have seen Panost, Oz Minerals. You can also probably throw Sandfire in there as well. Maybe not as much as those two from before that have been really beaten up over the last year because of that copper situation, and they've also got structural issues. But that's where the copper price is, and you can see that at the moment, if you've got less demand from US housing because of slowing monetary policy going into the US economy because of that unwinding and tapering, and then you go to the other side of the world where you've got China, where they also are slowing down, possibly on their construction situation, also the fact that they are winding in speculative lending and also fraudulent invoicing. That's all a real big sort of V index to push on copper, and that's what we're seeing at the moment. It is disappointing. We are a resource nation. We do see copper as one of our largest exports, and we saw that in our trade balance, that copper was out at around about 3.06 billion tonnes of copper in the last month. So that's a little bit disappointing to see the copper price going away and possible demand in the future also dropping away. And that is something to watch over the coming months heading into that March sort of settlement date. Yeah,
because Evan, we've chatted about this week already. It's iron ore is also sort of showing signs of that anticipated and happening China slowdown. So when we get the trade data today, what are we watching for? We've seen a trend of sort of lower exports from global trade data that's being released. So do you think that is a trend likely to continue in China and then having that impact on our market today?
Yes, unfortunately I do. And you've also got to take it with a grain of salt. You've got to look at the fact that in December, most of the ordering, particularly from its major trading partners being Europe and the US, for the Christmas shopping period have already been done. So this is the December trade balance figures we see today. Expectations, according to Bloomberg, so that's the consensus, around about 28 economists there, suggesting the current surplus will narrow slightly to around about 132.6 billion US dollars. But it's the export figures that we want to see, and whether or not the slowing of that is actually accelerating, and whether or not we see any sort of talk from the central government or the PBOC that may stimulate that. From what we saw in the CPI data yesterday, and if you had have looked at 2013 and also 2012, expectations would be that you would see that. But judging by what we've seen pretty much since that third plenum, where they have started to talk about becoming a consumer nation, becoming a little bit more urbanised, becoming a rising middle class sort of nation as well, that seems slightly unlikely. And even with a disappointing print today, you are unlikely to see the central government or the PBOC getting involved, which means we're going to see more speculation about how China is slowing, whether or not come Tuesday with the GDP print it's going to be below expectations, which is 7.6, 7.7% GDP for the full year of 2013. On estimates, the official government reading is supposed to be 7.5. So that is going to probably put weakness into our market. We do currently look like we're sitting flat. We're currently calling the ASX dead flat to what it closed yesterday, but it's all about that change balance data, and therefore front running into Tuesday's GDP print out of China as well.
I know, and without sort of getting too far ahead of ourselves, how do you think that this story is likely to play out come earnings season here, which likely will be a good time for the market to take stock and perhaps even a catalyst in whichever way?
Yeah, and I'd have to agree with that. And I think, again, you've got to start looking away from the macro themes, which is what we've just been talking about for the last 5 minutes. But if you look at what you see from the bottom-up views, If you have a look at iron ore pricing in Aussie dollar terms, over 2013 it only declined 3.1%. So that is actually quite a good thing to see. Most people had actually expected to decline 10, 15, even as much as 20% to around about 100 to 110 US dollars a tonne, which would equate to roughly around 125, 130 Aussie dollars a tonne, and it's nowhere near that kind of market at the moment. So you should see, considering the record numbers out of Port Hedland, the record uptake from Rio, Fortescue, etc., that has been around, that come February numbers, it should actually be a good number. But at the moment, we are front running on macro themes. We are all concerned about China. We are all concerned about the demand for not just iron ore, but industrial metals as a whole across the region and across the globe. And that's what we're seeing. We'll put that in perspective. This week alone, the actual numbers going through the ASX currently sit roughly on an average around about $1.8 billion traded hands. Last year, the average price per day was $4.6 billion traded hands. So that puts in perspective how light the trading is at the moment. So yes, we are talking about a real movement down in the material space, and it has been quite dramatic over the week. But if you equate it to the volumes going through, it is very light, and that's why price action at the moment is quite sort of probably distorted is the word I'd use, concurrent trading compared to what it was in 2013.
Okay, Evan, let's get company specific then and talk Fox, 21st Century Fox in particular, looking to exit its Australian listing, moving to the NASDAQ to increase, I should say it's already on the NASDAQ, but looking to increase its liquidity on the NASDAQ. How significant a loss is this for the Australian market?
Yeah, it is, and look, from an Australian-centric point of view, it is disappointing. You've got to look at it first of all, from a business perspective. Completely understandable. Almost roughly 90% of assets that Fox have are in the US or in the North American asset perspective, so also in Canada, parts of Mexico as well. But in saying that, from an Australian-centric point of view, it is disappointing. It was probably one of, if not the best, international exposure stock you could buy directly on the ASX. Really had good tailwinds particularly, and the delisting is going to be a big loss to our market, and that is disappointing from an Australian-centric point of view. Understand it from a capital management and from a company point of view, but it is disappointing. Watch it today. There is talk to the fact that there's no suggestion of a share buyback or anything like that, and that is just the fact we haven't heard a huge amount of information about how they're going to delist yet. You may see a bit of a flurry of selling today. Fund managers particularly have been quite up in arms over the last sort of 12 hours about the talk about this delisting, and they may try and exit at what is a fairly good price at the moment, around about $38 Aussie for the share price on the Australian listing. So you may see a bit of a flurry to sort of exit the market. It may actually provide a bit of a chance to get in as well, because there may be down the track, when they do look at exiting stage right, which suggests to be around about April, that you may actually get some sort of, you know, a bit of a handout from the company as they do a walk away. But all in all, from an Australian-centric point of view, it is disappointing. It's the largest media-listed company in that space. We are, you know, not a fairly diverse sort of stock exchange, unfortunately, and it was a good area to be in Fox itself. So disappointing after 7 months splitting out from its old situation of being News Corp. And this is just further reiteration of what Rupert Murdoch wanted to do around about 7 or 8 years ago, when he wanted to actually pick up News Corp completely and move it to the US, and that was blocked. He's got around it in other ways, and that's what we're currently seeing on this morning's news. The plan's coming to fruition. Okay, Evan, thanks for chatting, and we look forward to speaking with you later today. Thanks, Nadine.
Great insight as always coming from Evan Lucas.